A policy designed to protect Americans from 25% interest rates is about to push 47 million of them into 400% debt traps. That's not a typo. The January 2026 credit card cap that headlines are celebrating as a consumer victory is actually the trigger mechanism for the largest credit extinction event in American history. Most analysts are focused on how this hurts banks. They're missing the real story entirely. This isn't about Wall Street profits. This is about what happens when the government tries to reprice money itself for political gain. Let me show you the architecture of a trap. Maria Santos still remembers the exact satisfying moment she clicked Pay Balance on her Chase credit card app last October. Standing in her kitchen in Bakersfield, California, her hands still damp from washing dishes after her nursing shift, she watched $18,000 of debt disappear. 15 years of minimum payments, late fees, and 24% interest compounding against her. Gone. She screenshot that zero balance and sent it to her daughter with 3 heart emojis. 4 months later, in January 2026, Chase closed her account entirely. No warning. No explanation beyond a form letter citing portfolio risk management. Maria is 54 years old, has worked as a registered nurse for 23 years, and now has no access to emergency credit for the first time in her adult life. Here's what makes Maria's story so disturbing. She did everything right. She paid off her debt. She never missed a payment in the final 3 years. Her FICO score climbed to 668, just above the subprime threshold. And none of it mattered. Because the same week Maria's account was closed, the President of the United States signed an executive order capping credit card interest rates at 10%. The policy was supposed to help people like Maria. Instead, it erased her from the financial system. Let me show you a number that should keep you up at night. 82 to 88%. That's the percentage of all credit card accounts in America that become unprofitable under a 10% rate cap, according to the American Bankers Association's internal analysis. Not marginally unprofitable. Deeply, existentially unprofitable. The kind of unprofitable where banks don't negotiate or restructure. They simply close the account and walk away. Think about what that means. We're not talking about a small adjustment to the credit market. We're talking about the mathematical elimination of credit access for the majority of American cardholders. And the people who will suffer most aren't the wealthy borrowers with 780 FICO scores and $50,000 limits. It's the 47 million Americans with subprime credit who were already hanging on by their fingernails. Derek Washington learned this in the worst possible way. Derek is 41, a truck driver out of Memphis who spent 8 years building his credit back after a bankruptcy in 2016. His Discover card had a $300 to $500 limit and a 26% APR numbers that made his financial advisor wince every time they met. But that card was Derek's emergency fund, his buffer against the unexpected. When his transmission blew on I-40 outside Little Rock last month, he pulled into the repair shop knowing that $200 repair would go on plastic, and he'd figure out the payments later. The card was declined. Account closed effective January 15th. Derek sat in that repair shop parking lot for 2 hours, calling every number he could find, and nobody could help him. He ended up at a payday lender across the street that charged him an effective APR of 340%. The loan to fix his truck, the truck that earns his living, will cost him over $400 to $100 by the time he pays it off. This is the part most people get wrong. They see a 10% rate cap and think about the math from the borrower's side. 10% is less than 25%, so borrowers win, banks lose. Simple. Except credit card economics don't work that way, and anyone telling you otherwise is either lying or hasn't looked at an actual bank balance sheet. The truth is brutally mechanical. A bank's cost of funds ties to the prime rate, which currently sits at 6.75%. A 10% cap leaves exactly 3.25 percentage points of margin. Out of that margin, the bank must cover credit losses. For prime borrowers with excellent credit, those losses run 2 to 3%. For subprime borrowers like Maria and Derek, default rates regularly exceed 10%. The math doesn't just fail to work. It's not even close. Add operating costs, fraud detection, customer service, and the reserves regulators require, and you understand why banks aren't absorbing losses out of solidarity. They're running, and they're running fast. Picture a map of the United States lighting up red county by county as credit card accounts go dark. Start with the Mississippi Delta, Appalachian Ohio, the Central Valley of California, the Rio Grande Valley. These are the regions with the highest concentrations of subprime borrowers, the places where a credit card isn't a convenience, it's survival infrastructure. Now here's a question that should bother you. If 47 million people lose access to bank credit, where do they go? They don't stop needing money. When the car breaks down, when the medical bill arrives, when the hours get cut and rent is due in 3 days, the need for credit doesn't evaporate because a bank closed your account. It just gets more desperate. The answer is payday lenders, title loans, pawn shops. And in the darkest corners, loan sharks who collect debts with methods that don't involve late fees. The average payday loan carries an effective APR between 300 and 400%. The cruelest irony in American financial policy is this: a regulation designed to protect consumers from 25% interest rates will push millions of them into 400% interest rate traps instead. But the credit card apocalypse is only half the story. What's happening in housing is even more dangerous because it involves something Americans were promised would never happen again. Remember 2008. Remember Fannie Mae and Freddie Mac, the mortgage giants that collapsed and required the largest government bailout in history. After that crisis, regulators forced these institutions to build capital reserves, a safety buffer, so taxpayers would never have to rescue them again. That buffer took 15 years to build. It currently stands at roughly $170 to $180 billion combined. On January 8, 2026, President Trump ordered Fannie and Freddie to spend $200 billion buying mortgage-backed securities to push rates below 6%. Let that sink in. He ordered them to spend more money than they actually have. Jennifer Okonkwo is a housing attorney in Atlanta who's been watching this unfold with growing horror. She's 38, spent her career helping first-time buyers navigate closing documents, and last week she told her husband she doesn't know how to advise clients anymore. The rules that governed housing finance for 15 years were just thrown out, she said. We're flying blind. Jennifer remembers sitting in her office in 2008, watching the system collapse, thinking at least we'll never let this happen again. Now she's not sure what's protecting anyone. On the other side of this equation sits Ronald Chen, 62, a real estate investor in Phoenix who owns 14 rental properties outright. When rates dropped below 6%, Ronald immediately refinanced 3 mortgages, locking in savings of $1,400 per month. He's planning to use that money to buy 2 more properties this spring. The lower rates go, the more he can leverage. Ronald isn't a villain in this story. He's just playing by the rules the government created. But those rules are accelerating a wealth transfer that most Americans don't even see happening. Here's the second question that should haunt you. If $200 billion in new demand floods into a housing market with chronic supply shortages, what happens to prices? This isn't a trick question. It's Econ 101. Lower rates don't create more houses. They create more buyers competing for the same inventory. The affordability benefit of cheaper mortgages gets eaten by rising prices. First-time buyers like Jennifer's clients don't get ahead. They just run faster to stay in the same place. Meanwhile, investors like Ronald, who can move faster and pay cash, capture the gains. We are witnessing the architecture of a trap being built in real time. Not a trap set by any single villain, but a trap created by the collision of political desperation, mathematical impossibility, and a financial system that was never designed to be manipulated this way. The credit card cap and the housing intervention aren't separate policies. They're two halves of the same strategy, an attempt to reprice money itself for political advantage. And there's one more piece we haven't discussed yet: the Federal Reserve. The institution designed since 1913 to resist exactly this kind of pressure is currently under attack from the Department of Justice itself. What happens when the last firewall between political money and market money finally burns down? That's where this story truly begins. To understand why a 10% credit card cap destroys the very people it claims to protect, you need to understand something most Americans never learned in school. The price of money is not determined by kindness, fairness, or political intention. It's determined by risk. And when governments try to override that equation, mathematics doesn't negotiate. It simply finds another exit. Think about lending the way a neighborhood restaurant owner thinks about extending credit to regular customers. Imagine you run a small diner in Cleveland. Tony comes in every day, orders the same breakfast, always pays his tab on Friday. You'd let Tony run a tab for a week without thinking twice. Now imagine a stranger walks in, orders the most expensive thing on the menu, and asks to pay next month. Different calculation entirely. You don't hate the stranger. You just don't know if he's coming back. That uncertainty has a price. In the credit card business, that price is called the risk premium, and it's the mathematical core of everything we're about to discuss. Here's how credit card economics actually function. A bank borrows money at roughly the federal funds rate, currently around 4.5%, then adds a margin for the prime rate, which sits at 6.75%. That's the bank's cost of funds, the baseline before any profit. When a bank issues you a credit card at 24% APR, the difference between 6.75% and 24% isn't greed. It's a calculation covering four distinct costs. First, expected losses from borrowers, who will never pay back. Second, operating expenses for customer service, fraud detection, and transaction processing. Third, regulatory capital reserves the bank must hold against outstanding loans. Fourth, and only fourth, actual profit. For a borrower with a 780 FICO score, default rates run around 1 to 2%. The math works beautifully at almost any interest rate. But for a borrower with a 620 FICO score, historical default rates exceed 10%, sometimes reaching 15% in economic downturns. This is why Maria Santos, the nurse from Bakersfield, who paid off her debt and built her score to 668, still lost her account. Her score crossed the subprime threshold, but the bank's risk models still flagged her segment as unprofitable under a 10% cap. She wasn't rejected for what she did. She was rejected for what borrowers who look like her statistically do. Picture a giant spreadsheet with 200 million credit card accounts, each one tagged with a probability of default. Now watch what happens when you impose a 10% ceiling. The profitable accounts, those shaded green, shrink to a small corner. The unprofitable accounts, shaded red, swallow nearly everything else. That visualization represents the American Bankers Association's finding that 82 to 88% of accounts become unsustainable. Banks aren't making a political statement when they close these accounts. They're responding to arithmetic. Now let's talk about who actually controls the price of money in America, because this is where the story gets dangerous. Since 1913, the Federal Reserve has operated as an independent institution, deliberately insulated from political pressure. The logic is simple and historically proven. Politicians facing elections want cheap money. Cheap money makes voters feel good in the short term, but cheap money sustained beyond what the economy actually needs creates inflation. Inflation destroys savings, destabilizes planning, and eventually requires brutal correction. The Fed exists to make unpopular decisions, to raise rates when the economy overheats, even if it costs the president an election. That independence isn't a bug in the system. It's the entire point. What most people get wrong about Fed independence is imagining it as some abstract principle that professors debate in seminar rooms. It's not abstract at all. It's the reason your grandmother's savings account means something. It's the reason $1 today will probably buy roughly $1's worth of goods next year. The moment politicians can control interest rates for electoral advantage, that anchor disappears. Money becomes a tool of power rather than a measure of value. Raymond Tillman understands this history better than most. Raymond is 71, a retired economics professor from the University of Chicago, who spent his career studying the 1970s inflation crisis. He keeps a framed photo in his study of Arthur Burns, the Fed chairman who Richard Nixon pressured into keeping rates low before the 1972 election. Burns complied. Nixon won. And then inflation exploded to 12%, devastating a generation of savers and requiring Paul Volcker to impose interest rates above 20% to finally kill it. Raymond has watched the current administration's attacks on Jerome Powell with a specific kind of dread. "I've seen this movie before," he told his graduate students last week. "It ends with a lot of people losing everything they saved." On January 15, 2026, the Department of Justice served grand jury subpoenas to the Federal Reserve. The official reason cited cost overruns in renovating the Eccles Building, the Fed's headquarters in Washington. The actual reason, transparent to anyone who's followed this administration, is building a legal case to remove Jerome Powell for cause before his term expires in May 2027. Here's a question that should disturb you. What happens to global confidence in the dollar when the world's reserve currency becomes visibly subject to political manipulation? The answer arrived within 48 hours of the DOJ announcement. Gold prices blasted past $4,600 an ounce, a new record. The dollar weakened against the euro and yen. Most significantly, bond traders began selling U.S. Treasury securities. Not because they expected inflation next month, because they expected the Fed would be forced to let inflation run rather than fight it. This is what analysts call the Sell America trade. It's what happens when sophisticated investors decide that U.S. assets now carry a political risk premium, a term previously reserved for countries like Turkey, Argentina, and Venezuela. Patricia Oyalaran manages a $2.3 billion bond portfolio for a pension fund in Sacramento. She's 49, has spent 22 years navigating interest rate cycles, and last month made a decision she never expected to make. She reduced her fund's treasury holdings by 15% and moved the allocation into German bunds and Japanese government bonds. "The yields are lower," she admitted, "but I can't model political risk. I can't put a number on what happens if the Fed loses independence. When I can't model something, I reduce exposure." Patricia's move, multiplied across thousands of institutional investors, is precisely how a currency begins to lose its privileged status. But here's the contrarian point that complicates this entire narrative. The administration isn't acting irrationally. It's acting politically, which follows its own cold logic. President Trump faces the 2026 midterms with $1.23 trillion in credit card debt crushing American households at an average APR of 21%. Mortgage rates have hovered near 7%. His voters are angry about affordability, and that anger will express itself at the ballot box. From a pure electoral calculation, forcing rates down makes sense. The benefits arrive immediately in headlines and consumer relief. The costs, the credit deserts, the inflation, the institutional damage arrive later, dispersed harder to trace back to any single decision. Remember Derek Washington, the truck driver from Memphis, whose Discover card was closed, forcing him into a 340% payday loan. Derek voted for Trump in 2024 specifically because of promises to lower interest rates. He believed cheap money would help people like him. Now Derek is trapped in a debt spiral far worse than anything his credit card ever imposed. But when the payday loan comes due, he won't blame the rate cap policy. He'll blame the payday lender, or his own bad luck, or the transmission that failed at the wrong moment. The political feedback loop is broken. The people harmed by the policy don't connect their harm to the policy that caused it. This is the mechanism that makes financial populism so dangerous. The beneficiaries know exactly why they're benefiting. The victims rarely understand why they're being victimized. The investor with a 780 FICO score, who keeps his credit card, celebrates the rate cap. The subprime borrower who loses access and spirals into predatory debt blames everyone, except the regulation that pushed her there. Now picture the White House Situation Room maps showing approval ratings by congressional district overlaid with maps showing credit card debt concentrations and housing affordability indexes. This is how policy gets made when money becomes a political variable, not by asking what's economically sound, but by asking what moves numbers in swing districts before November. And this brings us to the second half of the trap, the housing market intervention that makes the credit card cap look almost modest by comparison. When President Trump ordered Fannie Mae and Freddie Mac to spend $200 billion buying mortgage-backed securities, he wasn't just trying to lower interest rates. He was commandeering the capital reserves that protect the entire American housing finance system. These reserves took 15 years to build after the 2008 collapse. They exist precisely to ensure taxpayers never have to bail out these institutions again. Marcus Chen is a financial analyst at Moody's who covers government-sponsored enterprises. He's 36, joined the firm right out of business school, and spent last week running stress tests on Fannie Mae's balance sheet under various scenarios. "The numbers don't work," he said, staring at his models. "They're being asked to deploy more capital than they have. Either Treasury provides a backstop, which means taxpayer exposure, or they're betting housing prices never decline. That's not risk management. That's hope." Here's the second question that should keep you awake. If Fannie and Freddie exhaust their capital buying mortgage securities to lower rates and housing prices decline even modestly, who pays for the losses? You already know the answer. You paid for it in 2008. You'll pay for it again. The firewall between political ambition and financial stability isn't just cracking. It's being deliberately demolished brick by brick, institution by institution. And the most dangerous part hasn't even happened yet. What comes next isn't just a policy failure. It's a transformation of how money works in America. Let me show you the lie at the center of this entire story. The public narrative is simple and emotionally satisfying. Greedy banks have been exploiting American consumers with predatory interest rates for decades. Finally, a president had the courage to stand up to Wall Street and cap those rates at a fair 10%. The little guy wins. The fat cats lose. Justice is served. That narrative is not just wrong. It's the exact opposite of what's actually happening. And by the time most Americans realize it, the trap will have already closed. Here's the truth nobody in Washington wants to admit. The 10% rate cap doesn't transfer money from banks to consumers. It transfers risk from regulated institutions to unregulated predators. It doesn't make credit cheaper. It makes credit disappear for the people who need it most, then reappear at 4 times the price in the shadows of the financial system. The policy isn't Robin Hood. It's a trapdoor. Darnell Cooper figured this out 17 days ago. Darnell is 38, works as an HVAC technician in Baltimore, and has spent the last 6 years rebuilding his credit after a medical bankruptcy nearly destroyed him. His Capital One card had a $4,000 limit and a brutal 27% APR. But Darnell treated that card like a loaded weapon, using it only for genuine emergencies. Last month, his daughter Keisha needed dental surgery that insurance wouldn't fully cover. The out-of-pocket cost was $100. Darnell reached for the card he'd protected for 6 years. Declined. Account closed under the new risk parameters. Standing in that oral surgeon's office, Darnell felt something break inside him. He'd done everything right. He'd worked double shifts. He'd paid minimums when money was tight and extra when he could. He'd watched his FICO score climb from 540 to 651 point by agonizing point. And none of it mattered. The system that was supposed to reward his discipline had simply erased him. Darnell got Keisha's surgery done. He found a title loan company that would lend against his work van, the van that carries his tools, the van that is literally his ability to earn a living. The loan was $2,500 at an effective APR of 247%. If Darnell misses 2 payments, he loses the van. If he loses the van, he loses his job. If he loses his job, he loses everything else. This is not a side effect of the policy. This is the policy. The math guarantees this outcome. Picture a funnel. At the top, 47 million Americans with subprime credit who currently have access to bank credit cards, regulated institutions with disclosure requirements, dispute processes, and legal limits on collection practices. Now picture those 47 million being pushed down through the narrow neck of that funnel into the unregulated basement below. Payday lenders, title loans, pawn shops, and at the very bottom in the darkness, loan sharks who don't file paperwork and don't go to court. What most people get wrong about predatory lending is thinking it's some fringe phenomenon, a few storefront operations in bad neighborhoods. The payday lending industry alone processes over $30 billion in loans annually. Title loans add another $20 billion. These aren't peripheral players. They're a parallel financial system waiting to absorb everyone the banks reject. And thanks to the 10% cap, the banks are rejecting people by the millions. Remember Maria Santos from Part 1, the nurse who paid off $18,000 and got her account closed anyway? Maria found out last week that her credit score dropped 47 points after Chase closed her account. The closure itself damaged her credit. The average age of her accounts dropped. Her credit utilization ratio became unmeasurable because she has no credit to utilize. Maria did everything right, and her reward was a credit score that now sits at 621, below the subprime threshold she fought so hard to escape. She's worse off than before she paid her debt. Now, let me show you who actually benefits from this policy, because this is where the rage should start building. Victoria Hartwell lives in Greenwich, Connecticut, in a house worth $4.2 million. She's 52, sits on 3 corporate boards, and carries an American Express Centurion card with no preset spending limit. Victoria doesn't pay interest on credit cards because Victoria doesn't carry balances. She pays her statement in full every month and collects approximately $18,000 annually in rewards points, which she uses for first-class flights to her vacation home in Aspen. Those rewards points are funded by interest payments from borrowers like Darnell and Maria. That's how the credit card ecosystem works. High-interest payers subsidize rewards for premium cardholders. When the 10% cap eliminates that interest revenue, banks face a choice. Eliminate rewards programs entirely, or restrict them to wealthy customers who generate revenue through transaction fees on high spending. Guess which option they're choosing? American Express announced last week that starting in March, its rewards program would be restructured around spending tiers rather than universal point accumulation. Translation: Victoria keeps her points. Everyone else loses theirs. The 2% cashback card that middle-class families use to offset grocery costs is being quietly discontinued. The airline miles that let a teacher from Ohio take her kids to Disney World once every 3 years are evaporating. The rate cap is not a wealth transfer from rich to poor. It's a wealth transfer from the working poor to the genuinely wealthy, mediated through a policy that sounds progressive but functions regressively. Pause for a moment and consider the symmetry of what's happening. Darnell Cooper, the HVAC technician, loses his credit card and ends up paying 247% on a title loan that puts his livelihood at risk. Victoria Hartwell, the Greenwich socialite, keeps her premium card with enhanced benefits and pays exactly 0% interest because she never needed credit in the first place. The policy designed to help people like Darnell is systematically destroying people like Darnell while protecting people like Victoria. This is not an accident. This is how financial populism always works. But wait, there's another layer to this story that makes it even worse. Remember the $200 billion housing intervention we discussed in Part 2, the order for Fannie Mae and Freddie Mac to buy mortgage-backed securities to push rates below 6%. Let me show you who captured those benefits. In the 6 weeks since rates dipped below 6%, mortgage refinancing applications from borrowers with credit scores above 740 increased by 34%. Applications from borrowers below 680 increased by only 8%. The rate drop helped people who already owned homes and had excellent credit. It did almost nothing for first-time buyers or anyone struggling on the margins. Brandon and Jessica Mueller are exactly the kind of family the policy was supposed to help. They're both 31 high school sweethearts from Grand Rapids, Michigan, who have been saving for a down payment for 4 years. Brandon works in automotive supply chain management. Jessica teaches 4th grade. Combined income $127,000 a year, solidly middle class. When rates dropped below 6%, they thought, finally, this is our moment. It wasn't. The rate drop triggered a surge in buyer demand that pushed prices up faster than the rate reduction pushed payments down. The house they'd been watching, a 3-bedroom colonial listed at $340,000 in November, sold for $372,000 in January, after 17 competing offers. The Muellers were outbid by an investor group paying cash. Jessica cried in their apartment that night, the apartment they'd been trying to escape for 4 years. "We did everything we were supposed to do," she told Brandon. "We saved. We waited. We didn't buy things we couldn't afford. And someone with a pile of cash just took our house." Visualize the American housing market as a game of musical chairs where the music just got faster. More buyers circling the same number of chairs. Lower rates don't create new houses. They just accelerate the competition for existing inventory. The winners are sellers and investors who can move quickly. The losers are first-time buyers who need mortgages and time. Here's a question that should make you angry. If the administration knew the housing intervention would primarily benefit investors and wealthy refinancers, why did they do it anyway? The answer is headlines. Mortgage rates below 6% is a headline that polls well. House prices surge. 9%. Pricing out. First-time buyers is a headline that appears 3 months later, buried on page 6 after the midterm votes are counted. Ronald Chen, the Phoenix investor. We met in part 1, closed on 2 more rental properties last week. His portfolio now generates $23,000 in monthly rental income. The rate drop alone saved him over $2,000 a month in carrying costs, money he's using to fund down payments on additional acquisitions. Ronald isn't cheating. He's not breaking any rules. He's simply operating in a system where the rules have been rewritten to benefit people with existing capital. The gap between the public justification and the actual outcome has never been wider. The public story says, "We're helping American families afford homes." The private reality says, "We're engineering a wealth transfer from aspiring homeowners to existing property holders funded by the capital reserves that were supposed to protect taxpayers from another 2008. Now here's the twist that even sophisticated observers have missed. The credit card cap and the housing intervention aren't separate policies. They're 2 halves of a coordinated financial repression strategy. Keep interest rates artificially low. Force savers to accept returns below inflation. Channel desperate borrowers into predatory alternatives. Transfer wealth upward while generating headlines that suggest the opposite. Financial repression is a term economists use to describe how governments quietly default on their obligations through inflation rather than explicit non-payment. The United States has $34 trillion in debt. If real interest rates go negative, meaning inflation exceeds the rate the government pays on that debt, the debt burden shrinks without any visible default. The people holding that debt, pension funds, retirees, foreign governments, absorb the loss through purchasing power that erodes invisibly. This is the great repricing. Money itself is being repriced not by markets, but by politics. The cost of credit, the value of homes, the stability of the currency. These are no longer determined by supply, demand, and risk. They're determined by whoever controls the levers of power and needs to win an election in 10 months. Marcus Chen, the Moody's analyst. Stress testing Fannie Mae's balance sheet, quit his job last Friday. Not because he was fired. Because he couldn't sign his name to projections he considered fictitious. "They're asking us to model scenarios where housing prices only go up," he told his wife. "That's not analysis, that's propaganda. I spent 10 years building credibility. I won't burn for this." Marcus walked away from a $340,000 salary because he couldn't live with the lie. How many others and how many institutions are looking at similar numbers, seeing similar impossibilities, and choosing silence because the cost of speaking is too high? The answer to that question determines whether this ends in managed correction or systemic crisis. And we haven't even discussed what happens when the 10% cap expires in 2027. 23 million Americans currently carrying balances at the artificially suppressed rate are about to discover that their 10% card can legally snap back to 28% overnight. The trap isn't closing. The trap has already closed. Most people just don't know they're inside it yet. What comes next isn't just a policy failure. It's a reckoning. The cruelest thing about financial traps is that they don't announce themselves. There's no explosion, no single moment of collapse that forces you to confront what's happening. Instead, there's a slow bleeding, a gradual erosion that feels like bad luck or personal failure, until you look back years later and realize you were drowning the entire time. This is what makes the January 2026 policies so dangerous. They won't cause a crisis next month. They'll cause a crisis that takes a decade to fully reveal itself, by which point the people who designed it will be long gone from power, and the people who suffered it will blame themselves. Let me show you what America looks like in 2034. Darnell Cooper, the Baltimore HVAC technician who took out a title loan to pay for his daughter's dental surgery, never recovered. The loan's 247% APR compounded faster than he could pay it down, even working 60-hour weeks. 8 months after the original loan, he missed his second payment. The title company repossessed his van. Without the van, Darnell lost his job. Without the job, he lost his apartment. In 2027, at age 39, Darnell moved in with his sister in Dundalk, sleeping on a fold-out couch, while his daughter Keisha took his old room. By 2034, Darnell is 46. He works part-time at a warehouse distribution center, earning $18.50 an hour with no benefits. His credit score sits at 498 deep in the subprime basement, locked there by 7 years of cascading defaults that all trace back to a single $2,500 loan he never should have needed. The credit card that was taken from him, the one with the 27% APR he once considered predatory, would have cost him roughly $200 to pay off that dental bill over 2 years. The title loan cost him his career. Picture a timeline stretching from 2026 to 2034, with Darnell's trajectory traced in red. Job loss at month 8, eviction at month 14, bankruptcy filing at month 30. Every subsequent year, a flat line of survival-level income, never recovering enough altitude to escape the gravity well of that initial collapse. Now let me show you the parallel timeline. Victoria Hartwell. The Greenwich board member used the rate cap era to optimize her portfolio. When banks eliminated rewards programs for middle-class cardholders, American Express introduced an ultra-premium tier exclusively for clients spending more than $500,000 annually. Victoria qualified easily. Her new card generates approximately $47,000 in annual rewards, up from $18,000 before the cap. She uses those points to fly private to board meetings, a tax-advantaged perk her accountant structures as business expense reimbursement. By 2034, Victoria's net worth has grown from $12 million to $19 million, an appreciation rate of roughly 6% annually in real terms. Not because she worked harder or smarter, but because she owned assets during an era when asset prices were systematically inflated by policy. Her Greenwich home appreciated $1.3 million. Her stock portfolio rose with the tide of cheap money. Her access to credit remained pristine, while 47 million Americans were expelled from the system entirely. Draw those two trajectories on the same chart. One line ascending steadily into the upper right corner. One line descending, flattening, never recovering. Same country, same decade, same policies. Radically different outcomes determined almost entirely by where you started. This is what financial repression looks like over time. It doesn't feel like theft, because there's no single moment of taking. It feels like gravity, like the natural order of things, like some people are simply luckier than others. But it's not luck. It's architecture. Here's a question that should haunt every policymaker who voted for these measures. In 2034, how many Darnells will there be for every Victoria? The math is not complicated. 47 million subprime borrowers were at risk of losing credit access under the 10% cap. Approximately 31 million actually lost access in the first 18 months. Of those, an estimated 8 to 12 million ended up in alternative financial products with rates exceeding 100% APR. The cascade affects job losses from repossessed vehicles, evictions from income disruption, bankruptcies from compounding debt will take a full decade to work through the system. What most people get wrong about economic damage is imagining it as an event, a crash, a crisis, a moment you can point to on a calendar. But the real damage from financial repression is durational. It's measured in years of lost wealth accumulation in children who couldn't go to college because the family never recovered, in retirements that became unaffordable, in small businesses that were never started because the founder couldn't access credit. Remember the Muellers from Part 3, Brandon and Jessica, the Grand Rapids couple who lost their dream house to a cash investor. Their story doesn't end in 2026. It extends forward into a future shaped by that single loss. By 2030, Brandon and Jessica are still renting. Not because they gave up, but because the math never recovered. The rate drop that was supposed to help them triggered a price surge that moved faster than their savings could accumulate. Every year they tried to catch up, prices rose another 6 to 8%. By their mid-30s, they realized they were running on a treadmill that only went backward. In 2034, Brandon is 39. Jessica is 39. They have 2 kids now, ages 5 and 3, growing up in a 2-bedroom apartment that costs $100 a month. Money that builds no equity, creates no wealth, passes to a landlord who owns 14 units in their complex. They've spent roughly $200,000 in rent over 8 years, enough for a down payment twice over if they hadn't been spending it on someone else's mortgage. The investor group that outbid them in 2026, a Phoenix-based LLC, sold that house in 2029 for $418,000, a $46,000 profit in 3 years. The LLC used that profit to fund acquisitions in Nashville and Austin, compounding their portfolio at 12% annually, while the Muellers compounded nothing. Now let me show you what this looks like at the national scale, because individual tragedies aggregate into systemic transformation. Argentina provides the clearest parallel. In the 1990s, Argentina pegged its peso to the dollar and ran aggressive financial intervention policies designed to create short-term stability and political advantage. Inflation stayed low. Credit flowed. The headlines celebrated. Then in 2001, the architecture collapsed. The peso devaluation wiped out the savings of the middle class overnight. A generation of Argentines who thought they were building wealth discovered they were building sandcastles below the tide line. The United States is not Argentina. The dollar's reserve currency status provides buffers that the peso never had. But those buffers are not infinite, and they erode with every policy that prioritizes political convenience over institutional credibility. The Sell America trade that began in January 2026 has not reversed. Gold, which broke $4,600 that month, trades at $5,340 in 2034. The dollar has weakened 11% against a basket of major currencies. Foreign central banks, which once held 60% of their reserves in dollars, now hold 51%. These shifts sound technical, abstract, but they represent something concrete: the slow erosion of the privilege that has underwritten American prosperity since World War II. Here's the contrarian point that even critics of these policies often miss. The damage isn't primarily about inflation or currency collapse. It's about institutional trust. Raymond Tillman, the retired Chicago economist who watched the 1970s replay itself, published a paper last year titled "The Credibility Discount." His thesis is simple and devastating. When governments visibly manipulate monetary policy for political gain, economic actors adjust their behavior accordingly. Businesses hesitate to make long-term investments because they can't trust price signals. Investors demand higher risk premiums. Lenders tighten standards beyond what raw default risk would suggest. The entire economy operates with sand in its gears, not because anything catastrophic happened, but because nobody trusts the system to behave predictably. This is death by 1,000 cuts. Not a heart attack, but a slow organ failure that takes years to become undeniable. Patricia Oyeleran, the pension fund manager who moved assets out of treasuries in 2026, now manages a fund that has underperformed its benchmark by 1.3% annually for 8 consecutive years. The irony is bitter. Her defensive positioning, born from legitimate concern about political risk, cost her investors returns they would have earned if she'd simply ignored the danger signs. The Sell America trade was correct in its diagnosis, but early in its timing. Patricia's career never recovered. She retired in 2032, 2 years early. Exhausted by the cognitive dissonance of watching a system she knew was broken continue to function just well enough to punish anyone who bet against it. This is how managed economies operate. They don't collapse according to schedule. They lurch forward, defying predictions until one day they don't. Let me tell you about someone who understood this dynamic and exploited it perfectly. Chen Weilin is a Taiwanese semiconductor executive who moved to Austin in 2021 to lead a chip fabrication facility. By 2026, he'd accumulated enough capital to begin investing in American real estate. Weilin understood something most American observers missed. The 10% credit card cap and housing intervention weren't bugs. They were features of a system designed to inflate asset prices while suppressing returns to labor and savings. He bought 16 single-family homes in Austin between 2026 and 2030, financing each at rates subsidized by Fannie Mae's market intervention. By 2034, his portfolio generates $38,000 monthly in rental income, managed by a property company, while Weilin focuses on his primary career. His net worth has grown from $2.1 million to $7.3 million in 8 years. Weilin is not a villain. He's an educated observer of financial systems who recognized that American policy had created a massive wealth transfer mechanism from non-asset holders to asset holders, from people who needed credit to people who didn't, from the future to the present. He simply positioned himself to receive rather than to give. Here's the question that should be asked in every congressional hearing, but never is. For every Weilin who gained $5 million, how many Darnells lost their vans? How many Mullers lost their chance at home ownership? How many Marias lost their credit scores? The arithmetic of financial repression always balances. Someone is always paying. The genius of the system is making the payers invisible, while the beneficiaries appear on magazine covers. We are 8 years into a transformation that will take another decade to fully manifest. The children growing up in the households of the losers, the Keishas and the Mueller kids, will enter adulthood with fewer resources, less stability, and diminished expectations. They'll compete for jobs and housing against the children of the winners, who will start with inherited down payments and family connections and credit scores unblemished by any memory of struggle. This is how inequality compounds, not through dramatic expropriation, but through years of tilted tables and loaded dice and policies that sound progressive while functioning regressively. The policies of January 2026 didn't cause a crisis. They built one brick by brick, year by year, invisible, until it wasn't. And the worst part? We knew. The warnings were clear. The mechanisms were documented. The historical parallels were obvious to anyone willing to look. We knew, and we did it anyway because the benefits were immediate and the costs were deferred to people who hadn't yet realized they were the ones who would pay. That brings us back to now. Back to you. Back to the question of what any of this means for someone watching in 2026, still early enough to understand the architecture of the trap. Let me bring you back to where we started. Maria Santos, the Bakersfield nurse who paid off $18,000 and watched her Chase account disappear anyway. I spoke with Maria last week. She's still working the same shifts, still living in the same house, still trying to rebuild what the system took from her. But something has changed. Maria started a savings account in January, the old-fashioned kind that earns 3.7% interest at a local credit union. She deposits $400 every month, money she used to put toward credit card payments. In 18 months, she'll have enough for a 6-month emergency fund that doesn't depend on anyone's algorithm or risk model. Maria told me something that stuck with me. She said I spent 15 years playing their game, following their rules, and they still closed my account. So now I'm playing my own game. I don't know if I'll win, but at least I understand what I'm playing. That shift in understanding is the entire point of everything we've discussed for the last 50 minutes. Not to predict the future, not to tell you what to buy or sell, not to claim some secret knowledge that will make you rich. Just to see the architecture clearly enough that you can make your own decisions instead of being made by someone else's. The pattern we've traced through this video is not unique to January 2026. It's a pattern that repeats throughout financial history, wearing different masks but following the same script. Political pressure forces interest rates below their natural level. Credit flows to those who don't need it while disappearing from those who do. Asset prices inflate benefiting owners while pricing out aspirants. The costs get deferred, dispersed, disguised as bad luck or personal failure. And by the time the damage becomes undeniable, the architects have moved on to their next project. We saw it in the 1970s when Nixon pressured Arthur Burns. We saw it in Argentina before the peso collapse. We saw it in the years before 2008 when easy money inflated a housing bubble that nearly destroyed the global economy. The faces change, the mechanism doesn't. Here's the contrarian point that might surprise you. Recognizing this pattern doesn't mean you should rage against the system or retreat into gold coins and bunker supplies. The people who profit most from financial repression aren't the ones who fight it. They're the ones who understand it clearly enough to position themselves on the right side of the transfer. Ronald Chen, the Phoenix investor, who expanded his rental portfolio during the rate drop, isn't a villain. He's someone who understood that government policy was about to inflate real estate prices, and he acted accordingly. Victoria Hartwell isn't evil. She's someone who recognized that premium credit products would become more valuable as mass-market products disappeared. These people didn't create the rules. They just read them more carefully than everyone else. Picture a river flowing downhill. You can stand in the middle and complain about the current, or you can understand which direction the water flows and position yourself accordingly. The river doesn't care about your complaints. It responds only to gravity. What most people get wrong about financial literacy is thinking it means knowing which stocks to buy or which assets will appreciate. That's not literacy, that's prediction, and nobody consistently predicts markets. Real financial literacy means understanding the forces that shape outcomes, the incentives that drive behavior, the mechanisms that transfer wealth from one group to another. It means asking the right questions even when you don't know the answers. Let me give you a framework. Not advice, just questions to ask yourself. First, in any policy change, who benefits immediately and who pays later? The timing of benefits versus costs tells you almost everything about political motivation. Second, does this policy make me more dependent on institutions or less? Dependency is vulnerability. Third, what happens if this policy reverses? Every intervention eventually ends. The 10% cap expires in December 2027. The Fannie Mae purchases will eventually stop. If you've structured your life around temporary conditions, you've built on sand. Derek Washington, the Memphis truck driver, is still paying off his title loan. He'll finish in August, nearly 2 years after his Discover card was closed. The total cost for that $2,500 loan will exceed $5,800 when he's done. But Derek learned something too. He's been driving for a logistics company that offers a 401k match, and he's contributing 6% of every paycheck. In 20 years, assuming average returns that account could be worth over $180,000. It won't undo the damage, but it might prevent the next crisis from destroying him completely. Here's a question worth sitting with. If you had understood in January 2026 exactly what we've discussed in this video, what would you have done differently? Not what stocks would you have bought, but what dependencies would you have reduced? What emergency fund would you have built? What assumptions about institutional reliability would you have questioned? The goal isn't to become a financial genius. The goal is to become slightly harder to trap. Raymond Tillman, the economist who watched the 1970s repeat themselves, told me something last month that crystallized everything. He said, "The difference between people who survive financial crises and people who are destroyed by them usually isn't intelligence or luck. It's lead time. The survivors saw it coming 6 months earlier and made small adjustments before small adjustments became impossible. The victims waited for certainty that never came. We're living through a moment of unusual clarity. The mechanisms are visible. The policies are public. The historical parallels are documented. This isn't some hidden conspiracy that requires special access to understand. It's architecture sitting in plain sight, waiting to be seen by anyone willing to look. Visualize the American financial system as a building with load-bearing walls. The Federal Reserve's independence is a load-bearing wall. The capital reserves at Fannie Mae and Freddie Mac are load-bearing walls. The regulated credit card system that provides transparent pricing to 200 million Americans is a load-bearing wall. Each of these walls is being stressed, not demolished overnight, but weakened incrementally, load shifted elsewhere. Structural integrity compromised in ways that won't become obvious until the next storm. The building might stand for years. It might stand for decades. But the margins of safety that previous generations built are being spent down to purchase political advantage in a single election cycle. That's not a prediction of collapse. It's an observation about resilience. I want to be clear about what I'm not saying. I'm not saying the dollar will collapse. I'm not saying you should sell everything and buy gold. I'm not saying the economy is doomed or that there's nothing to be done. Financial nihilism is just another form of learned helplessness. And learned helplessness is exactly what benefits those who profit from your inaction. What I am saying is this. The price of money has become a political variable. The institutions designed to protect ordinary people from political manipulation of credit are under attack. The costs of this transformation will be paid primarily by people who don't understand what's happening to them, while the benefits flow to people who do. Darnell Cooper didn't understand. The Muellers didn't understand. Maria Santos didn't understand until it was too late. But understanding came eventually, and understanding changes what's possible. This video wasn't about giving you answers. It was about giving you the questions that make answers possible. What happens when interest rates become political tools? Who wins when credit disappears from the regulated system? Where does the money go when 47 million people are pushed out of bank lending? These aren't rhetorical questions. They're the analytical framework for navigating whatever comes next. The headlines will keep celebrating. The policies will keep being sold as victories for the common person. And somewhere in Memphis and Bakersfield and Grand Rapids and 1,000 other places, people will keep falling through trap doors they never saw coming. But you've seen the architecture now. You've traced the mechanisms. You've watched the pattern repeat across decades and continents. What you do with that knowledge is up to you. The system doesn't care whether you understand it. It will operate exactly the same way, regardless of your awareness. But your life might turn out very differently, depending on whether you're positioned with the current or against it. Maria Santos figured that out. Darnell Cooper is figuring it out. The question is whether you'll figure it out before the next trap closes. They told you 10% interest rates were a gift. Now you know what it actually was. The only question left is what you'll do with what you know.